For 3 relentless years, Hong Kong's stock market endured its harshest winter. The Hang Seng Index, once the crown jewel of Asia's financial hub, collapsed as China's economy slowed, property empires crumbled, and foreign capital fled. From a lofty peak near 30,000 in early 2021, the HSI plunged below 15,000, levels unseen in more than a decade. Trillions in market value vanished. Analysts gave up, dismissing China and Hong Kong stocks as simply uninvestable. The mood on the ground was no better. Ordinary investors walked away. Tea houses and restaurants, once alive with heated debates about the next hot stock, turned eerily silent. Hong Kong equities had ceased to be a source of fortune. They became a symbol of despair. Then, almost without warning, the ice began to crack. In mid-2024, Beijing unleashed a wave of stimulus measures and support schemes. The so-called national team, state-backed funds with deep pockets, marched into the market, joined by major institutions. The impact was immediate. From its trough near 14,800, the Hang Seng Index roared back just below 20,000 within 4 months. For investors trapped in Hong Kong equities for years, it was a long-awaited moment of relief. Many rushed to sell into strength, grateful simply to escape. But confidence was still fragile. Few believed the rally could last. Sure enough, the market corrected sharply at the first peak, touching the 16,500 support level. Before cautious investors dared to buy back, the HSI had already resumed its climb, punctuated by brief pullbacks, until it broke decisively above 26,000. Retail investors looked on in frustration, lamenting that they had missed the boat. What they didn't realize was that this might not be the end of a rally, but only the prologue to a super bull run orchestrated by hedge funds in the making. Hi, I'm Freeman, an independent investor focused on listed equities in the US, Hong Kong, and Singapore exchanges. Over the past decade, Hong Kong stocks have been a core part of my portfolio. In earlier years, they often outperformed my Singapore holdings, but the last 3 years have dragged on overall returns. Even so, I've held firmly to my major positions, from big tech names to institutional leaders in banking, insurance, and telecommunications. My conviction is rooted in the long-term prospects of China's economic transformation, and I remain unfazed by the recent rally. As the market climbed higher, friends began asking me whether they should sell before the HSI reached 30,000, a level they considered both difficult and unsustainable. As a contrarian investor, I found this sentiment telling. If most people think that way, perhaps the majority is wrong. Could there be a larger force, hedge funds, quietly shaping the next move? Based on my observations of market dynamics, the scenario of a potential super bull run began to take shape in my mind. But before I go further, let me be clear. Everything I describe here is entirely from my own imagination and logical reasoning about how hedge funds may operate. I have no insider knowledge of their strategies. And most importantly, nothing I share should be taken as financial advice. This is simply my personal perspective as an independent investor. Please do your own research and consult a qualified financial advisor before making any investment decisions. After the sharp rebound, the market's character began to change. The Hang Seng Index was no longer a playground for jittery retail traders. Instead, it became dominated by the national team, large institutions, and a handful of savvy retail investors with the patience and conviction to hold. Most of the trapped retail supply had already dissipated during the earlier surge, with only those who had bought near the extreme peak of 30,000 still stuck. Profit-taking supply from retailers was minimal, as so few had entered at the lows. In other words, the market was now in the hands of strong holders with very little overhead resistance left. For hedge funds, this was the perfect setup. With the US market trading at lofty valuations amid peak optimism, these funds could consider harvesting profits in America and shifting their battlefield to the other side of the globe, Asia Pacific, and specifically Hong Kong. Here was a market primed for acceleration, cheap, cleared of weak hands, and liquid enough to stage their next great campaign. The mid-2024 surge was more than just a policy-driven rebound. It was also a wake-up call for global hedge funds. They saw firsthand how easily the Hong Kong market could be moved. Since then, many may have already begun their first phase of action, quietly accumulating positions. To fund this accumulation, hedge funds bided their time, waiting for the perfect moment to harvest gains in the U.S. market, possibly now, as Wall Street rallies on hopes of interest rate cuts. With profits secured on one side of the Pacific, they could redeploy capital to the other. But accumulation in Hong Kong would never be straightforward. To build large positions without attracting too much attention, hedge funds are likely to engineer bouts of volatility, sharp pullbacks and sudden corrections designed to shake out weak holders. Each wave of fear gives them more room to buy. In doing so, they gradually lift and consolidate the market's average cost toward the critical 30,000 level, setting the stage for what comes next. Every bull market has its wall of doubt, and for Hong Kong, that wall stands tall at 30,000. This level is etched deep in investors' memories, the last major peak before the long winter began. As the index approaches, trapped positions from that era begin to stir. Those who endured years of pain see a fleeting chance to break even and rush to the exits. Selling pressure mounts, and a correction here is almost inevitable. But this is no ordinary pullback. The shakeout at 30,000 serves a larger purpose. It flushes out the final layer of weak holders, clearing the battlefield for what comes next. For hedge funds, it is the perfect final test, a manufactured storm before the skies clear for the true vertical leg of the bull run. Once the 30,000 wall is broken and the weak hands are flushed out, the path higher becomes startlingly clear. With supply absorbed, hedge funds can drive the Hang Seng Index upward with little resistance. The market accelerates rapidly, surging toward 40,000. Along the way, tactical corrections are staged, sudden pullbacks near 34,000 or 36,000, each one designed to lure retail investors into believing they've been given a second chance. Slowly, FOMO grips the sidelines. Retail investors, who spent years in disbelief, now begin piling in late, convinced the bull has finally arrived. By late 2026, the index approaches the fabled 40,000 mark, a major psychological milestone. To the retail crowd, it looks like vindication at last. But for hedge funds, this is the destination. Here, they begin to distribute quietly into the frenzy, selling gradually rather than in one sharp dump. The exit is disguised through slow, staggered selling, obscuring their true intent. What looks like strength to the retail buyer is, in reality, the smart money slipping out the back door. Behind the euphoria, storm clouds gather. The U.S. economy shows signs of strain, with recession risks looming larger by the second half of 2026. Hedge funds are acutely aware of the danger. Global contagion could spread fast, and they cannot afford to be caught exposed in Hong Kong when it hits. Thus, they accelerate their exit, pulling capital back across the Pacific. As foreign money retreats, the strength of Hong Kong's rally begins to fade. When the dust settles, the pattern is familiar. Retail investors, late to the party, find themselves trapped once more. They have become the bag holders, buying near euphoric highs only to face the cold winds of a financial storm. Meanwhile, hedge funds exit with full war chests, ready to redeploy at the next bottom. The cycle completes: despair, rebound, euphoria, collapse, and the game resets for another round. As compelling as the super bull run scenario appears, it is not inevitable. Hedge funds are masters of adaptation, and several factors could derail or alter this script. 1. Timeline risk. The entire playbook depends on the storm clouds over the U.S. holding off until late 2026. But if a downturn or financial shock arrives sooner, hedge funds may have little time to accumulate and distribute in Hong Kong. In that case, their priority would be capital preservation, not engineering a bubble abroad. 2. Policy intervention. The Chinese government has become far more vigilant about speculative frenzies. Should authorities judge that Hong Kong's rally is running too hot, too fast, they may step in with policies to cool the market, from tightening margin rules to direct guidance aimed at curbing retail speculation. Such intervention could break the cycle prematurely, cutting off hedge fund momentum before it peaks. Number 3, geopolitical and flow shocks. Hong Kong remains vulnerable to external shocks. U.S.-China tensions, export controls, or sudden restrictions on cross-border capital flows. Any flare-up could spook foreign investors and drain liquidity, disrupting the carefully staged sequence of accumulation, shakeouts, and distribution. In short, while the logic of a hedge fund-driven super bull run is strong, markets are never a one-way street. History shows that just when the outcome seems most predictable, surprises tend to strike. Final takeaways. Whether or not hedge funds follow this exact playbook, one truth is clear. Hong Kong's market has entered a new chapter. Years of despair have left valuations compressed, retail investors sidelined, and the market dominated by strong hands with long-term intent. That makes Hong Kong one of the most fertile grounds globally for a hedge fund-driven bull run. If you believe this scenario is likely, here's the framework. Build positions now. Focus on quality blue chips that move in step with the index. Treat every dip below 26,000 as a buying opportunity. Stay disciplined at 30,000. Hold firm even if the index breaks above this psychological barrier, but resist the urge to FOMO once it's already beyond that level. While 36,000 to 40,000 is only a hypothetical projection, if it ever hit this level, sell into strength. Hedge funds may seek to exit gradually, so use the rally to distribute your own positions into demand. Avoid chasing corrections at the top. Patience matters more than bravado once the market enters its late stage. And if the playbook doesn't unfold exactly as imagined, the principle still holds. It is always right to buy quality companies at good prices and hold them for the long term. Building positions now, while fear and doubt still linger, makes sense no matter what the market's script turns out to be. And again, the above is just my personal view as an independent investor. It is by no means financial advice. Please do your own research before making any investment decisions. Goodbye, and have a great day.